Welcome back to Markets with May. In this episode, we're going to talk about 5 things you should know when investing in dividend-yielding stocks. From time to time, different investment styles come into vogue, and I've gotten certainly more questions on dividend-yielding stocks of recent than any other time. And as I reviewed a bunch of material, I realized it might be time for a tutorial. Some of the information out there is close, but doesn't necessarily give you what you might need if you were truly to make a fundamental assessment. So we're going to go through 5 things in this video. First, the difference between dividend issuance and dividend yield. Second, are dividend stocks non-growth stocks and necessarily value? I'll give you a little hint. That's false. The third thing we're going to talk about is why a company might give a dividend in the first place and how you should think about it. The fourth thing we'll discuss is which types of companies tend to give you a dividend and also companies that kind of have to give you a dividend. And then number 5, I will just throw in a couple of other considerations if you're doing research to find dividend yielding stocks. But before we get into that, I have to always say past performance is not indicative of future returns, and when in doubt, consult a local professional who can look at your entire financial circumstance and provide good advice catered to your investment needs. It's always a pleasure to have people like, share, comment, or if this is helpful, subscribe to my channel. It helps me know what content to create. And finally, there is a paid version of Markets with May that includes a daily live Q&A and all kinds of other stuff. If you're interested in that, you can look at the comments below. So some companies issue a dividend, and the first thing you should know is that what they're doing is they are giving money back to shareholders. Now, there's more than one way that a company can give money back to shareholders. One way is to buy back stock, but a dividend payout is directly just moving capital from retained earnings to you, the shareholder. It's a way of saying thank you, and it would be the same as if you ran your own company and paid yourself some sort of income. It's a great thing. It's a very common thing. In fact, a lot of people don't realize, but the entire S&P 500, those 500 companies, once you roll up everything, they produce about a 1.3% dividend yield. So additionally, you can kind of think of that as an average dividend yield for a large cap company. It then kind of implies that if you have a dividend yield that's under 1.3%, you are not necessarily a high dividend yielding stock. You got to be over that hurdle or else you're not really higher than everybody else. Now, one of the important things to understand about dividend yield is that the way that a company or a board is thinking about dividend yield is a little bit indirect. They're not necessarily being like, we're going to make the dividend yield higher per se on a percentage basis. Instead, they're looking at company performance and then thinking about what capital should return to shareholders. From there, you do have to do the math. And the math is this: the dividend, the total that they're going to give back to shareholders divided by the market cap. That will give you the dividend yield. So let's break that apart a little bit. Number 1, they're giving money to shareholders out of retained earnings, meaning they're just giving you cash that they, in theory, could be using for other things. Now, hopefully that means that they got plenty of cash to be giving it back, and they've already allocated everything else in a way that's beyond and fantastic and wonderful. And so now it's time to give the shareholder their due for being wonderful shareholders. Now, let's say you have a huge dividend and also you got to pay back a bunch of debt that you don't necessarily have capital for. Well, in those cases, I wouldn't necessarily be interested, no matter how high the dividend yield is, because that company's stock is going to go down. This is a poor use of capital. So it turns out you always have to be aware of what the financials are if you're going to go into dividend yielding stocks. Now, the second part of that equation is market cap, and market cap is price times shares outstanding. And I mean, there's a little nuance to this. Some of you are going to be like, what about dilution? What about this? Don't worry about that right now. What you really need to know is that as the stock goes higher, the market cap increases, thereby decreasing the dividend yield. This is why when folks are just like, look for the highest dividend yield stock, realize that there may be other things to consider. In other words, what hopefully is driving the market cap of the stock up is people thinking that the prospects of this company are fantastic. And that is why sometimes what is driving the dividend yield down is the belief from investors that the prospects of this company are fantastic. In other words, the stock price is just getting higher and higher. The board is just issuing a dollar value. And then once you divide that by market cap, the dividend yield looks low. A really great example of that is a company called Prologis, which is the foremost warehouser that has as its largest customer Amazon. I know there's other people that also warehouse for Amazon, but Prologis, if you look at what they actually do in the way of innovation within warehousing, you'll find that they are fantastic. Similarly, within the REIT sector, there is a group of companies called the tower companies. And what they do is essentially rent out big towers that you see around the world that essentially are necessary for having wireless and various cable broadcasts that come through. Those companies, because it's the steadiest form of cash flow you'll ever see, tend to trade in a way that always makes the dividend yield lower than you would think. There's still reasonable dividends, but at one point when it was less certain that they'd be able to pay back their debt, long story, these things traded with a significantly higher dividend yield. I think when I owned them originally, they were yielding 6+%. And that brings me to my second point. Are dividend yielding stocks and growth stocks the opposite? In other words, are there growth stocks that have a dividend yield? And the answer to that is, yeah, definitely. There are growth stocks that have a dividend yield. The reasons for giving a dividend yield, which I'm going to go through next, do not have anything to do with whether or not that company is growth oriented. A growth-oriented stock, I'll do a separate video on that, is going to have a high level of revenue growth, a high level of earnings growth or earnings potential, margin expansion. It's going to have all these other characteristics. Alternatively, if it's not a profitable company, it's going to have a set of characteristics. But then if it has those characteristics, it's definitely not a dividend yielding stock. But the point is, there's plenty of growth and dividend yielding stocks. You just have to look for it. I mean, for me, my favorite dividend yielding companies are companies with a high dividend yield and still some prospects to improve their revenue and earnings potential. Because like I said, it's really all about whether or not they can pay that dividend. And I certainly don't want them paying that dividend if it's going to take away from future growth. I mean, realize when a company gives you back a pot of money, that actually has to come out of, like I said, retained earnings, which necessarily should reduce the market cap by the dollar value they just gave you. The only reason to do that is either because they're an older company that's not going to grow, and so they're just going to become this nice cash flowing thing to you. That's fine. You just got to prove out that that's going to continue to happen, especially in an inflationary environment, which in a lot of cases, inflation helps, not hurts certain industries. But what oftentimes happens, which is even better, is that they just have already applied all their capital to everything, still believe they're going to grow, and they just want to give you back some cash as a thank you to the investors for being great investors. Those, by the way, are my favorite ones to pick out. Now we're going to talk a little bit more deeply about why a company is given a dividend to begin with. And I've already touched on it a little bit in the sense that they may just be trying to return capital to shareholders as a thank you. They've already deployed capital to other areas of the firm for growth, or, compensating people adequately to retain great staff. All that stuff has already been taken care of in the ideal situation. And you should absolutely be doing your fundamental analysis surrounding this if dividend is your way to play. Now, the idea of stock buyback versus dividend issuance, that can get a bunch of fundamental nerds really, really excited to have a discussion, because in fairness, both are ways to give capital back to shareholders. If I increase the dividend yield, the expectation is that I maintain that give back to investors for a while. Now, there is a thing called a special dividend. A company that did that in the first quarter would be EOG. They gave a special dividend. They decided that they didn't want to make it a common increase to the dividend because they wanted potentially to have a little extra room for CapEx. Very cool. An alternative way to do it is to just buy back stock, thereby hopefully taking the amount of shares down and driving the price of stock up just by virtue of how the math works on that. And that one's as simple as market cap divided by shares outstanding, which is then reduced. So we're assuming that in this stock buyback, you actually retire the shares, which not everybody necessarily buys back stock and retires the shares. But in this case, we're saying you buy it back, you retire those shares, reducing the share count. Market cap stays the same. Share count reduces, therefore the price of the stock has to go up. Now, the reason a lot of fundamental nerds prefer this method versus giving a dividend back is because basically, if there is a potentiality for capital expenditures, if you know that this company goes through cycles, if you'd prefer them to be doing it to R&D, then a stock buyback can be quite lovely because it doesn't really put you on the hook for a certain amount of capital going forward. Now, in fairness, especially in oil and gas, you had both stock buyback and a dividend return because that's just how great that industry is doing right now. Now, another big consideration in why is the company issuing more dividend, raising the dividend or otherwise, is how exactly is it that they're paying management? Now, in a lot of cases, management is being paid stock with the idea of alignment that they would bring the stock price up by doing a series of wonderful things to invigorate growth. Again, why I'm saying that dividend yielding doesn't necessarily mean non-growth. Now, a lot of management teams are also dependent on the cash flow that comes from that dividend. And you're going to want to try to understand that dynamic a bit as you think about what is the nature of this dividend yield. Are they just giving it back to pay management, but there was no growth and this is no good? Or what is it exactly? And that brings me to a fourth consideration as relates to dividend yield. And that relates to which industries are likely to be given back a lot of dividend to begin with. Now, like I said, remember, in every single industry, even those that must give back a dividend yield, the price of the stock will be bid up, thereby lowering the dividend yield if the company's doing great. But there are some industries that almost by definition have to be given a dividend. The first one is 100% the real estate investment trust. I mean, that is the nature of that structure by tax law. They got to do it that way. And I'll let you read up on that separately, but the REITs are always a great place to look for dividend. Now, another place to look for that dividend yield is in healthcare. And it's very interesting why that is, but it's going to be accentuated in medical devices and pharma. Some of the other areas are going to be a little different. But what's actually happening there is because as these companies allocate capital to drug development, and then the cycle kind of happens, you'll get these lulls. And the dividend, in a lot of ways, mellows out some of those peaks and troughs. So here, you'll see a lot of growth. You'll definitely be investigating the pipeline, but the dividend yield can sometimes fluctuate. I've actually gotten very high dividend yielding pharma companies when they really have gone out of favor. I believe I purchased Lilly when it had over a 4.5% dividend yield. And that was because people just didn't believe the pipeline was going to do anything. That said, the pipeline did something, and that stock has rallied significantly from where I purchased it almost a decade or more ago. But medical companies, and in particular pharmaceutical companies, because they're still throwing off a lot of cash from existing drugs, they'll trade down, which will make the dividend yield look very large because really the market is saying, I'm not sure about this pipeline of yours, and it's still kind of something that we don't have clarity in. And so there you can oftentimes find great dividend yield in stocks, and if you do a little bit of work, you can find that there's potentially a lot of growth there as well. Right now, some of the stocks are trading very, very cheap, relative even to growth and also dividend yield, because I think COVID news has gotten mixed in the strangest possible way. And your everyday analyst might not be really differentiating the growth that's coming from COVID versus the growth that is necessarily coming out of the pipeline. One that I would have you investigate to see what you think is Pfizer, ticker PFE. It's trading at like 9 times earnings with plenty of stuff in phase 3 trials. So that's one to even just have a look at. Big cap, no difficulty whatsoever in paying a dividend yield that's currently around 3.3%. Now, the other area that absolutely is just historically always paid dividends is the oil and gas sector, and in particular the pipelines. A lot of that has to do with the fact that, especially in the pipelines, management is compensated via dividend, more so than any salary they're getting, period. So their job is to make sure that that company continues to cash flow a certain way and just pay out dividends. Every company that just has reoccurring cash flow of that nature is going to do what makes sense on a capital expenditure side, and then just give back that cash flow, because essentially they're a little bit like a utility. Now, in fairness, the utilities also do generate great dividend yields because they're not going to get that same growth. So that's kind of how they want to keep their investors happy. You really got to go company by company and understand regulation risk and also really appreciate what's going to happen in CapEx, because right now we're reconfiguring the utility companies pretty aggressively here in the United States. But again, I want to make it clear that it's because there's kind of a cyclicality at times to these industries. The dividend yield isn't huge because management is insane and just paying a dividend. The dividend yield is big because the entire sector has gone out of vogue and people have basically bid down the stocks, market cap decrease, such that the dividend yield looks a lot bigger. And especially in the case of a lot of the oil and gas companies now, what's happened is they're really benefiting from the inflation that's happened in the energy sector, the very, very tight supply conditions, and the fact that people just don't want to give them any love. Now, some of the other considerations related to whether or not you should invest in dividend stocks really has to do with what it is you're trying to do. Now, for me personally, even if it's an IRA where I don't have the taxable gains associated with it, I like to have a few dividend stocks there. And I like that because it throws off cash. And I can either reinvest it in the company that gave me the cash, or I can apply it to other things. Now, remember, I primarily like dividend yielding stocks where I can see very clearly there's a growth story as well. Growth versus value doesn't have to be a trade-off when it comes to dividend yield. Now, the other thing that can happen as well is that sometimes dividend yielding stocks become in vogue because the market environment has taken a twist. And this current market environment is kind of a mixed bag. We've got interest rates rising, and then you've got kind of a lot of uncertainty about the future of certain companies. So it's going to really be stock by stock, whether or not that company can support the dividend or not, and whether or not the capital loss on the share price is going to be so great that it's going to make that dividend insignificant to you, except if you've got a very, 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 very long time horizon. Now, I also want to mention that for any company that has a massively high dividend yield, I'm talking 8, 9, 10, etc. %, I cannot stress enough that you need to do your work to make sure that they can actually sustain that dividend yield. Now, a really good example of where it pays to do your work is in 2008, there were a bunch of companies, they were structured as a SPAC, that were essentially companies that held all of the assets that the banks were trying to get off balance sheet. So to be more specific and precise, there were a bunch of mortgage-related structures, CDO squareds, CDOs, even ABS, that the banks needed to write off and just get off of their balance sheets so they could move off in life. And they spun them out into this structure called a SPAC. And because everyone felt strongly that those things were mispriced to begin with and were going to trade busted and have very low rates of return relative to what they were, that those companies ended up trading with extremely high dividend yields. Now, in some cases, the market was right because those were terrible purchases at any price, you know. In other cases, the market on a total return basis was wrong because those continued to yield out 12 to 16% or whatever it was. Just remember though, every time they yielded them out, the stock had to dip associated with the cash that was given back. And so it would just kind of do this bouncing thing. And in some cases, if you look up the chart of these things, the price of the stock stays steady, but you just got to realize that they're giving you an 8 to 16 or something crazy dividend yield that entire period of time, which isn't bad from a total return perspective. In all cases, though, you have to have some sense for what the company's doing and whether or not they should, could, or would ever be able to sustain that dividend yield. And if you discover that that's just not the case, then that's, no matter how high the dividend is, you should not think of it as a great opportunity. Now, the last thing I'm going to say is that the smaller the cap of the company, the more potentiality there is that you really have to do your due diligence as relates to whether or not they can sustain the dividend. The logic kind of goes like this. When you're a small company, your future prospects are a little bit less known to you. You're still growing who's your customers. They're still getting to know you and making sure that you're always going to be the vendor of choice, that sort of thing. With the larger companies, there's probably a little bit more stability. Now that said, if you're a larger company that is getting market share taken away from you left and right, Or alternatively, you're a large cap company like AT&T and you're gonna have to do massive amounts of capital expenditures, then I could see why, even with a large dividend yield, you might still have some people selling your stock and reducing your share price greater than anything the dividend could ever make up for. Now that's all I've got prepared for in this episode. If you love dividend yielding stocks and you want to tell me about them, stick it in the comments below. If there were things that did not make sense in this video, I want to hear about it. It usually gives me great ideas for future videos. Again, it would be amazing if you would like, share, comment, subscribe to my video feed. That would be amazing.